Hey everyone, and welcome back to the deep dive. Today we're tackling something you see all the time. A company posts these huge net income numbers, big earnings announcements. Sounds fantastic, right? Pure profit. But here's the question we're digging into. Is that really the cash the business is generating, like the actual money an owner could pocket without messing things up? Or is there, well, something else going on under the hood? So our mission today is to really unpack that. We're exploring the crucial difference between net income and this other metric, owner's earnings. And we've done our homework, gone through some really insightful stuff, especially an article called Net Income Versus, to help us figure this out.
Exactly. And our goal is pretty clear. We want to show you why these two numbers, which seem like they should be similar, often tell very different stories. We'll break down what each one actually means and really why understanding this difference is, well, it's vital. Vital if you want to get a real sense of a company's health or if you're making decisions or even if you just want to be a smarter observer of the business world. We think you'll find that looking past those headlines reveals something pretty fascinating about how businesses actually work.
Okay, let's dive in. Let's start with the one we all know, net income. It's everywhere. What is it actually measuring? Why does it get so much attention?
Right. So net income, people call it the bottom line or just earnings. It's fundamentally an accounting profit. It's calculated using GAAP, that's generally accepted accounting principles. And the key thing is it's based on accrual accounting. What that means is revenues get counted when they're earned, expenses when they're incurred. It doesn't always matter when the cash actually, changes hands. So it includes everything: cost of goods sold, SG&A, interest, taxes, and importantly, things like depreciation,
Okay.
which aren't cash expenses in the current period. It's the official number.
Okay, so the official score based on a set of accounting rules makes sense. But then what's this owner's earnings? The name itself sounds, I don't know, more real, more tangible.
That's exactly the idea. Owner's earnings tries to measure something much closer to, well, the true cash that's available to the owners. That's after the business covers its everyday running costs, and after it spends what it needs to just maintain itself, to keep everything in good working order. Think of it like this. What's the maximum cash an owner could pull out this year without damaging the business's ability to keep operating and competing? Warren Buffett actually popularized the term because he wanted to know, what's the real take-home pay from owning a piece of that business?
Okay, so how do you get from net income to this owner's earnings number? Is there a formula?
Yeah, there's a standard way to think about it. You start with net income, then you add back non-cash charges. Depreciation and amortization are the big ones. These reduced your net income, but no actual cash went out the door for them this period, right? The cash was spent earlier.
Right, for the factory or machines.
Exactly. Then you adjust for changes in working capital. Like if inventory piles up, that ties up cash. If customers pay faster, that frees up cash. So that plus or minus goes in. And then this is really crucial. You subtract maintenance capital expenditures.
Maintenance CapEx, not just all capital spending.
Precisely. Just the spending needed to keep the business humming along at its current level, replacing worn-out equipment, essential upkeep. Not the spending on, say, building a whole new factory to grow bigger.
Okay, I think I'm getting it. So net income is the accounting profit by the rule book. Owner's earnings is trying to figure out the real spendable cash left over after keeping the lights on and the machines running. It's like accounting theory versus cash reality.
That's a great way to put it. One's a standardized report card, the other's about the actual economic fuel the business generates.
All right, here's where it gets really interesting for me. Why? Why do these numbers often diverge so much? What creates that gap between the accounting profit and the owner's cash?
Well, it really boils down to that accrual accounting we mentioned for net income. It's full of non-cash items and estimates. Depreciation is a big one, obviously. But think about stock-based compensation, too. That's a real expense. It hits net income, but it's not cash flowing out of the company's bank account, right? It's equity.
Good point.
Or asset impairments. If a company writes down the value of some asset, that crushes net income. But again, no cash is involved in that specific write-down moment. Owner's earnings, though, it tries to strip out all that accrual noise, as some people call it. It focuses purely on the cash, and critically, it only deducts the necessary capital spending, the maintenance part. That gives you a much clearer view of the cash you could actually deploy.
So it's trying to clean up the picture, get rid of the accounting estimates, and focus on cash in, cash out for essentials.
Exactly. Now, just a practical point here. In the real world, figuring out just maintenance CapEx is tricky. Companies don't usually report it separately.
Ah, okay. So how do analysts deal with that?
Well, they often use free cash flow, FCF, as a proxy. The common formula is cash from operations minus total capital expenditures. Now, someone like Buffett would ideally swap total capex for just maintenance capex if he could get the data. But since we usually can't, FCF is the closest publicly available number we generally use to approximate owners' earnings. It's not perfect because it includes gross spending too, but it's often the best we can do.
Gotcha. So FCF is like owner's earnings light, maybe? A practical substitute. But the goal is the same. Get past the accounting entries to see the real cash.
Precisely. That's the cash for dividends, buybacks, paying down debt, actual reinvestment, the real economic engine.
Okay, this makes so much more sense now.
Ah.
But let's make it concrete. Can we look at some actual companies? Seeing the numbers should really drive this home.
Absolutely. Let's look at the latest completed fiscal years for some big tech names. It's quite revealing. Let's start with Apple for their fiscal year 2024. Apple reported a massive net income, $93.7 billion. Huge number.
Wow.
But their free cash flow, our stand-in for owners' earnings, was even higher, $108.8 billion.
Higher, so a positive gap.
Yeah, a positive gap of $15.1 billion. What's driving that? Mostly, it's large depreciation charges hitting net income, remember, non-cash on assets they already paid for. Plus, their capex, while significant, is relatively modest compared to their scale. So more cash is sticking around than the profit number suggests.
Fascinating. More cash than profit.
Yeah.
That seems like a good problem to have as an owner. But not everyone's like Apple, right?
Yeah.
Especially with all the AI spending lately.
Exactly right. Let's flip to Microsoft. Fiscal year 2025, their net income, a whopping $101.8 billion.
Even bigger than Apple's.
Right. But their free cash flow, only $71.6 billion.
Whoa, that's way lower.
A negative gap of $30.2 billion. Almost a mirror image of Apple's situation, the key driver. Immense capital expenditures, building out cloud infrastructure, data centers for AI, plus they had a big swing in working capital, likely buying up hardware for AI.
$30 billion less cash than profit? That's a stark difference.
Yeah.
It shows how much they're reinvesting just to power that growth. And I bet we see this pattern elsewhere.
You bet. Look at Alphabet, Google's parent, fiscal 2024, net income, $100.1 billion. Free cash flow, $72.8 billion.
Another big negative gap, about $27 billion.
$27.3 billion negative gap, yeah. Again, AI-driven data center CapEx is the big story. They do get some cash flow benefit from adding back stock-based compensation, but the sheer scale of their investment spending overwhelms that.
Okay. And Amazon, they must be spending a ton too.
Absolutely. Amazon, fiscal 2024. Net income, $59.2 billion. Free cash flow, $38.2 billion. A negative gap of $21.0 billion. Enormous spending on fulfillment centers and AWS cloud infrastructure just drags that owner earnings number way down compared to the accounting profit.
Makes sense. And one more, NVIDIA. They're at the heart of the AI boom.
Right. NVIDIA, fiscal 2025, huge net income, $72.9 billion, but free cash flow was $60.9 billion, so a negative gap of $12.0 billion.
Still negative, but maybe less dramatic than Microsoft or Google.
Less dramatic percentage-wise, maybe, but still significant. For NVIDIA, it wasn't just CapEx for new fabs, but also a massive buildup in working capital, specifically inventory, getting ready for their new Blackwell GPUs. That tied up a lot of cash, even as their accounting profit exploded.
These examples are powerful. It really shows the difference.
It does. And the key thing isn't just the size of the gap, it's the direction. A positive gap, like Apple's, tells you GAAP accounting might actually be understating the cash generation. It's conservative. Good news for owners. But a negative gap, like we saw with Microsoft, Alphabet, Amazon, NVIDIA, that's a warning sign. It suggests the reported earnings might be painting a rosier picture than the actual cash reality for shareholders right now. This isn't just academic. That negative gap shows how these tech giants, even ones that seemed asset-light before, are now in this intense investment cycle, especially for AI. Their net income might be soaring, but a lot of that isn't translating into cash owners can actually access today. It forces you to think differently about their valuation.
Okay, so let's connect all these dots. What does this mean for you, listening right now? Why should you really care about net income versus owner's earnings? It sounds important, but how does it apply practically?
It's hugely practical. First off, it highlights just how critical capital expenditure intensity is today. As we saw, this AI race is forcing companies like Google and Amazon, companies we used to think of as software or platform businesses, into becoming massive physical infrastructure builders, heavy CapEx. And that directly shrinks their owners' earnings compared to net income. So if you're looking at a company with exciting net income growth, you have to ask, How much cash are they actually burning through just to achieve that growth? Are they a cash generator or a cash guzzler right now?
That's a crucial question. High profit doesn't always mean high cash flow.
Exactly. And second, and this is maybe the most important point, owner's earnings, or FCF as its proxy, is simply the better yardstick for valuation. If you're trying to figure out what a company is truly worth, maybe using a discounted cash flow model or just trying to gauge its ability to pay dividends or buy back stock, you need to look at the cash it actually generates for owners, not just the accounting profit. Especially for companies in these heavy investment phases, owners' earnings gives you a much more accurate picture of the company's real economic profit, the wealth it's actually creating. I've seen investors get tripped up by this so many times, focusing only on soaring EPS while ignoring negative free cash flow.
It really changes your perspective, doesn't it?
Mm-hmm.
It helps you avoid just taking the headline number at face value and gives you a deeper look at the company's real financial strength, like understanding the engine's power, not just how fast the speedometer needle is climbing.
That's a perfect analogy.
So for people listening who want to start doing this themselves right away, is there a quick mental checklist? If you pull up a company's financial report like a 10K or 10Q, how do you estimate owner's earnings? Where do you look?
Yeah, absolutely. It's pretty straightforward once you know where to look. First, go straight to the statement of cash flows. Find the line item for cash from operations. That's your starting point cash from the core business. Second, you need to subtract maintenance capital expenditures. Now, remember the catch.
Companies don't usually break it out separately.
Right. So if you can't find specific maintenance CapEx data, you use the reported total capital expenditures, often listed as purchases of property, plant, and equipment, as a conservative substitute. Subtract that total CapEx from cash from operations. What you're left with is free cash flow, FCF, and that's your best practical approximation for owner's earnings.
Okay, cash from ops minus total capex equals FCF, which is our proxy. Simple enough.
Pretty much. Then you can do a quick sanity check with a few adjustments if needed. Like if there was a genuinely huge one-off restructuring charge that hit cash flow but won't happen again, maybe add that back mentally. Or if the company made a big acquisition paid for with cash, that cash outflow isn't really from running the existing business, so you might want to adjust for that to see the underlying operational cash flow. And maybe try to mentally smooth out big seasonal swings in working capital, like a retailer stocking up for Christmas. Look at the trend over a full year, perhaps. But honestly, just focusing on that cash from operations minus total CapEx gets you most of the way there. It's this cash-based view. Well, it explains why investors like Warren Buffett often glance at the headline EPS but then dive straight into the cash flow statement. That's where the real story unfolds.
Fantastic. That's incredibly helpful. So the core insight here is crystal clear. Understanding the gap between net income and owner's earnings and focusing on that real cash generation gives you a much sharper, more actionable view of a company's financial reality. It's about getting beyond the accounting rules to the economic substance, understanding the engine, not just the speedometer.
Absolutely. And maybe a final thought for everyone listening to mull over. The next time you see a company's earnings report pop up, don't just look at the net income figure and stop there. Pause for a second. Imagine you actually own that whole business. Ask yourself, how much cash could I actually take out this quarter or this year? Go find that cash flow statement. Calculate the free cash flow. See how that number compares to the reported profit, especially if it's a company that's growing fast or investing heavily, like in AI right now. You might be surprised by what you find. What new insights will you uncover?
Great challenge. And if you are interested in tracking market valuation metrics like the one named after Buffett, or just keeping an eye on overall market temperature using data-driven approaches, you might want to check out the Buffett Indicator iOS app. It's available on the Apple App Store. Just search Buffett Indicator.
And just our standard reminder, all the analysis we've discussed today is based on public information and our interpretation. Things can change and other interpretations exist. This is purely for educational purposes. It's definitely not investment advice. You absolutely need to do your own research and due diligence before making any investment decisions.
Well said. And if you found this deep dive helpful, we'd really appreciate it if you'd like and subscribe on Apple Podcasts, Spotify, or our YouTube channel, Deep Value Investing. And don't forget, there's a list of great value investing books in the episode description. Thanks for tuning in.